All right, guys. Well, guess what? It's the new year. Happy New Year. That also means it's tax time. So taxes are going to be due April 15th. If you're a small business, you can push them out with an extension, usually 6 months. April, May, June, July. Let's see, March, April, May, June, July, August, September, October. Yeah, it's due in October. So we're just going to do a husband and wife, age 46, and our generation, I'm 46 as well, has to work till age 67 to get the full Social Security benefit. So that we're going to look at what they're doing now compared to what we could do for them that's new. So let's just dig into this real quick. We'll do this little case study together. And if you have questions, you can just post them in the comments or schedule a private session. I'll do your numbers. So let's see. Let's say this husband, the typical income is about $5,000 a month here in America. We're going to do we get paid monthly because I think we're going to do a small business. See, the wife has 5,000 income, so they each are making 60,000, total of 120. And then their small business related expenses, let's say you got about $2,000 a month. Let's say 1,500. What's 1,500 a month gonna be? 18,000 divided by 12. 1,500. Okay. So we're gonna say 18,000. Standard deduction. Let's see. For 2020, $24,800. So you can take the $24,800 standard deduction plus, if you have a small business, your Schedule C business related expenses, so 18 and 24. That's going to also appear over here. So all this stuff auto-populates here. So this will be an exact comparison. All right, so this couple is making, husband's making 60, wife's making 60, typical American family, 120 coming in. Got a small business, so they got some tax write-offs, writing off the cable, and they're writing off the internet and the phone and some of the space for the home office and maybe some gas and some office expenses, some website, some Zoom expenses, all those little things you pay for in your business that hopefully you kept the receipts for, or at least you're spending it all on your business account in your, let's just use Chase Bank. You're using the Chase business card to buy everything business. And you use your personal bank, let's call that Huntington, to do your personal. And then it's just easy at the end of the year. Everything you spend at Chase is business. Everything you spend at the other bank is personal, right? All right, so they've got 18,000 for business-related expenses. They're making 120. They got some write-offs here. And then mortgage interest deduction. Let's see here. Okay, so they got a house, paying them typically $1,000 a month. Yeah, that might be more realistic if you had 1,200. And up to year 24 and a 30-year mortgage, the 11 of those 12 payments are mortgage interest deductions in most cases. So we can know that $1,200 monthly mortgage payment times 11 is going to pay down the principal, and that is tax deductible, total $13,200 a year. And then if they have a rental property and they're splitting with, say, a brother to let grandma and grandpa live in there, let's say that's probably half the price of their normal mortgage. So $600 a month, one brother pays and the sister pays the other half. So let's say they get the mortgage interest deduction for that as well. So that's $6,600 total. So we've got 20, 20, another 20. So we got a total tax deduction of about 62,000 here. And let's see, if you are showing 77,000, what's your tax bracket? It's South Carolina. 77,000. Anything over 15 is 7. So South Carolina 7% is right. And then what about a federal tax bracket? We're showing 70,000. So we're between 40 in that. We're in the 22% bracket. Oh, for married, it's a little higher. So 80 to 171. So 19 to 20. It's only 12% for married. Okay. So you're here. I think we've got that correct then. Got that issued correctly. 12%. All right. So, if we can get your federal tax bracket, it's a lot of times as a couple taking more risk in the stock market to make a better return isn't as smart as taking advantage of a bunch of tax deductions and lowering your tax bracket and just overall making your adjusted gross income not big but small, right? So this is bigger, this is smaller. So right now we've got 120,000 coming in. We got a total deduction of 62,000. We're showing 77,000. That puts us in the 12% bracket. We're paying 9,600. If we can bump that down to 10 and pay and show much less, we'll only pay $640 on that federal tax. Can almost save you the whole 9,000 basically. And then there's you got your Social Security tax, Medicare tax, South Carolina tax if that's the state you live in, and your city tax. So we'll just call it city tax of whatever that would be. And I'm using most of these for Columbus, Ohio. Okay, so they're showing adjusted gross income of 77. They're paying taxes of 29%. If you add all this up, that's 22,000 out the door. And they're going to be doing that for 21 years. 22,000 times 21 years. Total pay to the IRS over the rest of their working life is 472,000. Now what we are going to do over here is take advantage of the same deductions for the Schedule C and that's taking the standard. But what we want to do is you are allowed to contribute to a 401k and an IRA if you have your own business. So it's 19,000 for him, blue for boy and pink for girl. 19,500 can be contributed for her as well if you're under the income limits. So we have 120,000. Let's see what the income 401k income limits are. Okay, what's the highly compensated limit for 2020? That's what we're looking for. 130,000. For 2021, the employee earns over 130,000. In 2020, so HCE for 2020. $125. Okay, so got to get it under 125. We're going to be fine in this case, right? In this case. So making 120, Schedule C gives us 18,000 right off of deductions, business stuff. Standard deduction, 24.8. Then if he maxes his 401k, it's 19,500 a year you're allowed to pack in there. Right here. And then in your IRA, you can contribute another 6,000. So if we get paid weekly, if we are giving ourselves a weekly check to keep cash flowing for groceries and whatnot, then if you own your own business, you need to have 375 to make this happen. These are the amounts that we'll have to automatically withdraw each and every week. We can set up on a monthly and multiply it times 4, but there's literally 52 weeks. So you take 19,500 and divide it by the weeks if you want to pay yourself weekly into your 401k and IRA. You divide the 19,500 by 12 if you're going to use a monthly payout because it's just easier for your business. So you do that on the 20th or something like that. All right, but if we do that, we get not only these deductions we had over here adding up to a deduction of 62,000, But we take that and then we add in 20 grand, 6 grand, 20 grand, another 6 grand. Now we're up to, instead of $62,000 tax deduction, we are up to 113,000 over here. We literally doubled it. So your adjusted gross income of 77 now becomes 6,400, and you drop to a lower tax bracket. Wait a minute, we can't live on 6,400 a year. So obviously this couple won't be able to max their full amount, or they got to make more money. So at the end of this little financial planning, we're gonna toggle the numbers till we find out what a couple needs to live on needs to be here in orange. So if you need, $2,000 a month for groceries and everything, $4,000. If you need $5,000 a month to run your family household, then we need this to say $60,000, 12 months times $5,000 a month, $60,000, right? So we need to bump this up. This couple's going to have to find a way to make some extra money, bump their Facebook ads or something for their business. They need to grow. But let's look at this. Our deductions were 62,000. Now they're pretty much double, 113. They were showing gross income of 77. Now they're only showing 6,000 bucks. So instead of paying taxes at 22,000 a year, they're only paying 1,700. And instead of the total paid to the IRS over the next 21 years of their life being $5,472,000, it's only 36,000. So I just saved you $436,000 by running this for you. And then this number right here, total retirement savings, if you fill these all up for 21 years, we will have not only saved you taxes of $500,000 roughly, but you'll have a retirement account if you only contribute and never invest a penny and let it get compounding interest. You never make any interest. If you just fill it up, that's your $1 million. So that's $1,070,989. Okay, so the money I saved you on taxes, the million we got built up for you. The total value received is 1.5, and we will do 1%. Let's see, equals this times this. Okay, so that's what we'll charge because we're valuable and we have to charge money. We can't keep working for free anymore. It's been too many years. It's been always. So this is going to be our fee, and you can pay in one fell swoop, or we can do, we can break it into, payments available. Okay, and that creates a cash flow for us. So we'll say we'll break that over 24 months, and this will equal that divided by 24. Okay, so you pay that amount per month. All right, so anyways, that is the value here. Now, where are we going to set this up? What are we going to do? There's some other things. Now, I told you we'd find a way to survive because nobody can save this much and live on $6,400 a year, right? So guess what we have to do? Let's toggle this number over here, and anything we change should always be yellow. So let's say we move this to, let's see what we got to do. Can we double our income? Let's say we can bump this up to $200,000 this year. That's going to give you $86,000 to live on, okay? So that is beautiful. So you'll still get your deduction. You'll have $86,000 to live on. Maybe you're like, oh, we don't need to pay that much in taxes. We can live on $60,000. So let's just shoot for $180,000. Now you know what you're shooting for 2021. Shooting for $180,000. It's going to give you about $66,000 to live on. Even if you only hit $170,000. You're going to come in a little shy. So, yep, probably the number you're shooting for is $180,000 gross income. We'll call this gross. All right, guys, cool little case study. Husband and wife, 46-year-olds, 20 years left to work. And, oh, We want this to actually equal So what we'd have to do here that's why this is green. So probably 7,500 would get it done. That's your monthly check you pay yourself out of the business. There, that gets you at 180,000. Still got our 60,000 to live on. We're putting back 113,000 and getting our mortgage interest and rental property deductions here. So there you go. You get 113,000 instead of paying 62. You're saving 18,000 on taxes and packing away. I guess we don't show the total here, but that's 20, 20, and 12. So 32,000 a year that you're socking back for 21 years. So that's how you end up here. Now we can actually make 7% compounding interest on that, which is pretty exciting. So if you made 7% compounding interest on, okay, let's call it 20, 20, and then another 12, 32,000. I'll have to build this into the sheet for you. That ought to work. Let's say 32,000 a year. We're starting with 0 monthly contribution. Length of time, we have 21 years to work. Estimated interest rate, let's say we can get you 7%. Range of interest rates, it can go up and down too. Compounding frequency annually. All right, so 21 years you'll have 1.4 million. Okay, so if you just save it, it's $1 million. If you let it compound at about 7%, you could end up with an extra $400,000 there. All right, so that's it in a nutshell, and we can work with you if you want to understand what you're doing now and why you're paying so much in taxes, because your deduction is okay, but you're still showing a lot of money and paying, in this case, $40,000 a year. And you want to cut that in half if you can. Okay, so these are some of the ways to do it. All right, look forward to talking with you. Hope that was helpful.